Good afternoon. I, Cyril George Spencer, and today we are diving into the world of income statement, which is the one of the fundamental financial documents that give us a snapshot of company's financial performance. Let's start by understanding what an income statement is and why it holds such significance. Income statement. It is one of company's core financial statements that shows their profit and loss over a period of time. The profit or loss is determined by taking all the revenues and subtracting all expenses from both operating and non-operating activities. The income statement is one of three statements which is used in corporate finance, including financial modeling and accounting. The statement displays the company's revenue, cost, gross profit, selling and administrative expenses, and other expenses, tax paid, and net profit in coherent and logical manner. It is also known as profit and loss account. Next, I'll focus on the importance of income statement. Now, why income statements are important? Well, think of them as compass guiding us through the vast sea of business finances. Here are few reasons why they matter. First, decision making. They help stakeholders like investors and managers make informed decision about the company's financial health. Second one is the performance evaluation. Income statements allow us to compare how a company is doing over time and against its competitors. Third, forecasting. They provide valuable data for predicting future financial performance and strategic goals. Now we'll look into the components of income statement. So, what exactly makes up an income statement? Let's break it down. First comes the revenue. That is, this is the money a company earns from selling its products and services. Next, we have the COGS, which is also known as cost of goods. These are the direct costs associated with producing the goods or services sold. Gross profit, which is calculated by revenue minus COGS, gives us the gross profit showing how much the money the company is making after accounting for direct cost of production. Then comes the operating expenses. These are the costs incurred running the day-to-day operations of the business like salaries, rent, and utilities. Operating income, which is calculated by gross profit minus operating expenses, gave us the operating income, which shows the profitability of company's core business activities. Then we have the EPS, division of net income by the total number of outstanding shares. Then we have the depreciation, which is the extent of which to which assets, for example, aging equipment, have lost value over time. And last is the EBITDA, that is earnings before interest, depreciation, taxes, and amortization. Here is the format of the income statement. As we can see, on the top is the revenue, then we add up all the revenues, then the expenses, then we total up the expenses, then we calculate the total expenses, then after that net income is calculated by uh, taking revenues total minus subtracting total expenses. Let's talk about the types of income statement. Income statements can differ depending on the accounting method used. There are mostly two types of income statements. First one is the single step income statement. This is a straightforward format where all revenues and gains are lumped together and all expenses and losses are grouped together. It is like a simple, easy to follow. It is calculated by net profit is equal to total revenue minus total expenses. Next, we have the multi-step income statement. Here, revenues and expenses are categorized further, providing more detailed insights into the company's financial performance. It is like a government bill, which each ingredient carefully measured and accounted for. It is calculated by gross profit is equal to net sales minus cost of goods sold, operating income, gross profit minus operating expense, and net income is equal to operating income plus non-operating items. Now we have the advantages and disadvantages of income statement. Now let's weigh the pros and cons of income statement. Advantages. They provide a clear picture of a company's financial health, help in decision making, and facilitate performance evaluation and forecasting. Second is the financial performance evaluation. Income statements offer a comprehensive overview of a company's financial performance over a specific period. They help stakeholders gauge the company's profitability, efficiency, and growth. Third is the decision-making support. By providing detailed information on revenues, expenses, and net income, income statements empower stakeholders to make informed decisions. Investors can use them to access the company's investment potential, while managers can use them to identify areas for improvement and strategic planning. Finally, finally, I would like to address the problems of income statement. The disadvantages are, however, they have limitations too, like not accounting for non-financial factors and being subject to manipulation or misinterpretation. First one is the subjectivity and manipulation. Despite their unusefulness of income statements are susceptible to manipulation and subjectivity. Companies may employ accounting techniques to enhance their financial performance artificially, such as revenue recognition or expense deferral, leading to misleading financial statements. Limited scope. Income statements primarily focus on financial performance metrics and they overlook non-financial factors which are critical to companies' overall success, such as customer satisfaction, employee morale, and market trends. Relying solely on income statement for the decision making may result in a narrow view of the company's health and performance. Now, I would like to conclude is that income statements are powerful tools that give us valuable insights into a company's financial performance. By understanding their components type and pros and cons, we can harness the power to make better informed decisions in the dynamic world of business. Thank you. I hope you found it insightful.